We're absolutely honored to have Howard Marks here with us today. Howard Marks is the co-chairman of Oaktree Capital Management, the largest investor in distressed securities worldwide. Since co-founding Oaktree in 1995, Mr. Marks has been key to Oaktree's investment philosophy, corporate direction, and outstanding investment returns. Mr. Marks is also a trustee and chairman of the Metropolitan Museum of Art Investment Committee and a member of the Royal Drawing School Investment Committee. He serves on the Shanghai International Financial Advisory Council and the Duke Kunshan University Advisory Board. He's also an emeritus trustee of the University of Pennsylvania and a professor of practice at King's Business School. Mr. Marks is the author of The Most Important Thing and Mastering the Market Cycle, both of which are must-reads for any investor. His memos have earned great praise from the investing community, including from Warren Buffett. When I see memos from Howard Marks in my mail, they're the first thing I open and read. Thank you for joining us today, Mr. Marks.
Pleasure to be here, Itai.
Excellent. So let's dive into the questions. So the first question is, what is your reaction to the idea that the Fed has made a commitment that it cannot keep by promising to hold interest rates near zero until a full economic recovery is complete? Given the importance of maintaining credibility, is there a risk that the Fed won't be able to change course even if inflation accelerates? And what are the dangers of carrying out such a policy during a time when financial markets seem to be in overdrive?
Well, unfortunately, the Fed has several objectives, some of which are in conflict. For example, they want to have enough growth to create jobs, but not so much growth that that we get inflation. And in addition, they want to redress inequality, and they want to deal with climate change. And now it looks like they want to keep us from having recessions and keep the market from having corrections. So you can't do all that stuff. And I think most of the people I talk to, and most of the people who are listening to this call, anybody who wants to listen to me, probably believes, as I do, that the free market is the best allocator of resources. And but you have to realize we don't have a free market in money, and we haven't had it in a long time. And I would say that interest rates have been artificially low ever since 2008 and the global financial crisis. And so, what does that do? Well, number one, it subsidizes borrowers and encourages borrowing. Number two, it penalizes savers and investors and retirees who have fixed incomes. And number three, when you lower the return on cash and safe investments, you make them unattractive. So you make people go out and do riskier things in order to try to get the returns they used to get safely. That's not good. There are benefits too. It kept the capital market open during the crisis, which was a great accomplishment, and so forth. But I just think that if I were running the Fed, which I have no ability to do and no interest, I would try to keep my hands off the markets and only get involved at the extremes. And I think we needed them in 2008 when Lehman went under and the global financial crisis, but we didn't need them to keep rates low in 13 and 14 and 15 when we were having a very solid, slow but solid recovery. And it looks to me like they have assured a very strong economic recovery this year and probably next. So I don't think the rates have to be as low as they are anymore. And the low rates plus all the monetary ease and stimulus and deficits and bond buying, people are concerned that it'll bring on inflation, which is undesirable. So, and as you say, can they do it forever? I believe that the Fed doesn't actually create anything. They only, like when they cut rates, they accelerate economic behavior from the future to the present. But that leaves a hole in the future. And then you go and you take from the further future into that future, but then the further future has a hole. I don't think you can do this stuff forever. And I think of the Fed as levitating the markets, which they certainly have done, from March 23rd until April 23rd of this year, the market was up 87%. It's like you can make security prices rise by buying securities. But that means you can never stop, because you ever stop, then it falls back to earth. And I just don't think they can do it forever or should have that objective. But that's just me.
Yeah, thank you for that commentary. It's very insightful. And a lot of people are wondering your opinion on the Serta Simmons ruling. And do you think that the creditor-on-creditor violence we saw last year will continue to play a significant role in future distressed opportunities?
I don't know enough about Serta Simmons to talk about it in any detail, but clearly the increased number of people and the increased amount of money in the distressed debt area is causing, hand-to-hand combat in some cases. And, there are people who believe that as investors or in their role as fiduciaries, they have to, try to get theirs by taking out of the other person's hide. And, I believe that to be a fiduciary does not require you to do things that are unethical. And the question is, where does unethical begin? It all started about 20 years ago, as I recall. We had the creation of something called event risk, which was a new term. But event risk, as applied to our businesses, was the possibility that companies would do things voluntarily, which would be good for the equity and bad for the creditors. And as I recall, the first big one was Hyatt. People were happy to lend money to Hyatt because they had so many hotels as collateral, even they wasn't strictly collateralized, but they were asset rich. And then people woke up one day and Hyatt was now not one company, it was two companies. And the debt was over there and the assets were over there. And apparently it wasn't. Debtors can do anything which is not prohibited by law or indenture. And this action was not prohibited. So some people took the approach that, well, let me back up a minute. A board of directors of a company has a fiduciary responsibility to the shareholders, not to the creditors, unless the company's insolvent. If the company's insolvent, then they take on a fiduciary relationship with the creditors. So people came to believe that since they have a fiduciary responsibility to shareholders, it's their job to take money out of the pockets of the creditors and put it in the money pockets of the shareholders. Well, I don't think it's universally accepted, but clearly some people have, and we are having these competitive restructurings where company needs money, and everybody would probably give them more money, but to make it easier and quicker, they go to one creditor and they say, or vice versa, maybe the creditor goes to them and says, we'll lend you $500 million, but we want to be at the top of the capital structure. And all the other people who own the same class of debt as us, we want them below us, because that increases our securitization. And they get it. So that's I don't know, it's an unpleasant development, but it may be reality.
Yeah, that makes a lot of sense. Thank you. And throughout your career, what would you say were the most pivotal financial or economic events that changed the way that you think about fixed income markets and distressed debt investing?
One of the things I believe is that experience is what you got when you didn't get what you wanted. And we don't learn much from success. we learn a lot. If we are wise, we learn a lot from our failures. And so I started off in the business in 1969 in the equity research department at Citibank. And the Citibank was adherent to what we called Nifty 50. They and most of the banks, and the banks were the big investors of the day. And we didn't have firms like BlackRock and so forth, and Blackstone and Oaktree and all these. It was mostly the banks and then the mutual fund companies. So they would buy the stocks of the 50 biggest and best and fastest growing companies in America, and companies that were so great that it was felt that nothing could ever go wrong. And because they were so great, there was no such thing as a price too high. And if you bought those stocks the day that I started work in middle of 69, and if you held them diligently for 5 years, you lost almost all your money. So I learned from that high quality of asset is not an insurance of success, because virtually any asset can be overpriced and consequently a bad investment. Then I switched to the bond department in 1978 to actually manage money, and I was very fortunate that was I was asked to start a high yield bond fund, and that was the beginning of the high yield bond universe. And now I was making money steadily and safely in the worst companies in America, worst public companies. So I learned from that there are very few assets which are so bad that they can't be cheap enough to be attractive. And the other thing was that the high yield bond revolution, if you will, of 1978 was based on the belief that if you put together a diversified portfolio of high yield bonds and they offered enough interest, that offset the fact that they had some credit risk. And so that was a big change, you see, because prior to that date, for the most part, you couldn't issue a non-investment grade bond. The market wouldn't take it. And fiduciaries couldn't buy non-investment grade bonds. They were considered to be unacceptable. In fact, Moody's defined a B-rated bond as follows, quote, fails to possess the characteristics of a desirable investment. Now, what does that mean? It means that it's not a good investment. Well, what about this bond? What about at 90 cents on the dollar? No. What about 80? No. 70? No. 60? Maybe. 50? Yeah. 40? Certainly. 30? Absolutely. So the point is, there's a price low enough that even risky assets can be attractive. And of course, that underpins the whole alternative investment world today. And in fact, the whole investment world. Because now, what do we talk about? Risk and return, risk and return. How much risk is there? Is the return adequate to compensate for it? If in that case, we make the investment. Professor Markowitz, one of his big contributions was to show people that if you have a safe portfolio and you add a risky asset, the portfolio becomes safer, because the new asset is uncorrelated with the old assets, which reduces the volatility. So risk return was like an epiphany, and then of course during the global financial crisis, during the tech bubble of 99 2000, I came out with a memo called bubble.com, which kind of blew the whistle on the excesses of the tech bubble. And, it turned out to be appropriate. And so that kind of opened my eyes to the desirability of understanding cycles and where we stand in them. Then in 2008, when the global financial crisis happened and Lehman Brothers went under and the markets collapsed, we didn't know what was going to happen any more than anybody else. People were talking about the end of the financial system. We didn't know that it wasn't going to happen, but we thought that our job was to invest. And so we did, and that worked out great. And Oaktree spent about 650 million a week in the last 15 weeks of 18, and that was good. So these were all experiences that I had that contributed to where I am today. And the key in investing is to keep your eyes open, understand what's going on, why it's going on, what you did wrong, what you could learn from it, and if you just go through life with your eyes closed, you don't ever progress. But if your eyes are open and you say not only what happened, but what does it mean? What's the significance of that? Then you can learn and get better.
Yeah, absolutely. Thank you for that commentary and advice. And so how would you create an optimal curriculum at this nation's top business schools to teach students value investing and distressed investing?
Well, of course, I mean, there are some programs that are very good. Columbia, for example, has a program dedicated to value investing. It's called the Heilbronn Center for Graham and Dodd Investing. And they do a great job. We're going to make an announcement tomorrow. Your colleagues should watch the screen tomorrow, because we're going to talk about educational opportunities. But look, there's so much. The great thing about investing is that there's so much that bears on it. There's accounting, there's finance, there's economics, there's computer applications and spreadsheets and so forth, and searches, screens. But then there's also, I'm a real student of investor psychology, which is fascinating. And, investing would be very, very simple, but not too profitable if investors always did what they're supposed to do, and they were always rational and objective and disciplined, and they never went to psychological excesses. But as my friend Rick Kane once said, 96% of financial history has occurred between two standard deviations, but everything interesting has happened outside of two standard deviations. And yeah, as I say, I think it's essential to learn these lessons. And then, of course, in the alternative space, you get into issues like debt restructuring, private equity, you got to actually help run companies, real estate. There are so many subsidiary fields. I don't know how to put together the curriculum, but if you watch tomorrow, you'll see we're going to try.
Yeah, excited for tomorrow's lecture then. And so right now, the net present value of Social Security and Medicare for the next 75 years will exceed tax revenue by about $50 trillion. What do you foresee as a solution to this unfunded liability?
I wish I had a magic wand that I could wave, and I wish I could give you the answer. Nobody, well, not nobody, few people in government want to tackle the hard questions. The trouble with the hard questions is that the answers include unpleasant elements. So let's take Social Security, for example. How can you fix Social Security? And we have a declining birth rate. We have a lot of restrictions on immigration. Social Security is really what's called a pay as you go. It's not an endowed pension fund. The young workers pay the retirement benefits of the retirees. Well, the trouble is we have the baby boom going through now. I'm like the youngest, the oldest member of the baby boom, because I was conceived during World War II, born shortly after. And, there are millions and millions that were born in the 20 years after me. And we're just starting to go through the retirement process. 10 years from now, you're going to have a huge number of retirees and not so many people working. So how do you fix Social Security? As follows. you have to do one or more of these things. You have to increase the amount of income that you tax for Social Security, increase the tax rate, reduce the benefits, delay the age in which you can get the benefits. There must be more, but as you can see, nobody's going to like those solutions. And there's no, you could, I guess that's most of them, but the point is, nobody likes those. And if you're a politician and you vote for those things, you'll lose votes because your constituents will be unhappy. But the problem is that dissuades people from fixing things, and then we have an insoluble problem. We need solutions. And by the way, it's unfortunate right now that the Democrats are trying to do X, Y, Z, and McConnell says my goal is to prevent them from doing anything. Now, one of these days, the Republicans will gain control, and the Democrats will be the loyal opposition, and they'll say our goal is to keep the Republicans from doing anything, which is fine as far as it goes, and if you looked at 25 or 30 years ago, people used to talk about how great gridlock is because it keeps the government from screwing it up. But the truth is, and your question about Social Security is a great example, there are problems that have to be solved and only government can solve them. And if each party is successful in making sure that the other party, when in power, can't do anything, how are we going to have any solutions? Well, you young people are going to have to figure that out. But I do say it's not this partisan warfare. Now, my greatest interest in politics right now, I'll digress for a second, is something called No Labels. And No Labels is trying to reduce the level of partisanship and try to encourage bipartisan solutions. And we have a caucus in the House called the Problem Solvers, which is 58 members, 29 Democrats, 29 Republicans, who have vowed to act in a bipartisan way on the things they agree on. And they and our allies in the Senate, Murkowski and Manchin and Romney and Sinema and people like that, they are they put together this solution on the infrastructure bill that is now under consideration, and it has a chance of working. And, when I was a kid, partisanship was not so terrible. The Republicans and the Democrats would have dinner together and golf together and drink together and work together. And, of course, people stopped living in Washington. They all go home on the weekends now, and they hate each other. Because you disagree with me now, I hate you. That's the new thing. And partisan politics has gotten terribly, it's a contact sport now, and that's not helpful. So I hope that No Labels can convince people to become less partisan. But we need solutions. And as I say, a lot of them have to come from government. We have government for a reason. There are things that the citizens can't do on their own.
Yeah, absolutely. And what do you believe are the most important investments that the US government should make in order to raise our rate of GDP growth, living standards, and global competitiveness?
I think the most important thing the government can do is improve the educational system. And I was brought up in a middle-class household in New York City, Queens, New York, and my parents didn't have much money, but I was able to go to the public schools and get a good education. They couldn't have afforded a private school education for me. Fortunately, the public schools were good enough. Now the public schools have really deteriorated, and most parents who can don't send their kids to public school, which in itself weakens the public schools, because it means that the people who go to public schools are the ones who have no choice, which is a certain group of people, and there's no diversity and there's no upward mobility. And so I think that and education improves everything. However, it'll take a generation or two. Even if you started today and if you improve things today, it would take a generation or two to have effect. And we don't want to wait 50 years. But I don't see an alternative. There's nothing that will solve the educational problem faster. And there are no other solutions really other than education, in my opinion. Of course, I think we should have constructive immigration policies, and with an emphasis on admitting the people who can contribute to our growth, and not just first come first served, or whoever can find their way in, but most countries, they have a process, and they require education, and some require economic commitment. Of course, we have people who want to come here for refuge who have no economic means. We should take some of them. But and by the way, it was recently reported about a month ago that the U.S. birth rate is now the slowest maybe it's ever been, or it's recorded, whatever. But the point is, the birth rate is very slow, and people are not having enough children to replace themselves, and that bodes very ill for economic growth. GDP is the total output of the country. So you can think about GDP as growth in GDP is the product of growth in the number of workers multiplied by the growth in the output per worker. Well, clearly, if we have a shrinking population, that makes it very hard for GDP to grow. And it's not a coincidence that the recovery that we had under Obama and Trump from 2009 through 19 was the longest in history, but also the slowest since World War II. And even when we had very generous stimulus from the Fed, we still had an extremely slow growth rate during this recovery from very depressed levels during the crisis. So I think that in the absence of population growth, it's challenging to grow GDP. So people say, well, we're going to have declining population growth, but we'll make up for it with automation. Makes sense? The trouble is, that doesn't create jobs, doesn't create incomes, doesn't let wage earners earn more. Maybe it makes them earn less. They talk about, I don't know if you've heard, Itai, I don't know if you've heard about the factory of the future, but in the factory of the future, there's one man and one dog. And the dog's job is to keep people from touching the machinery, and the man's job is to feed the dog. And so, if you think about it in that light, which is of course facetious, it's not very good for society. And technology is a help, and automation is a help, but it kind of helps us live without people as opposed to find a good place for people. So it's problematic. No easy answer.
Yeah, that makes a lot of sense. Thank you about that. And also, you discussed in some interviews recently how your son has really helped you to make a transition into both new financial assets such as cryptocurrencies, understanding them more, and then also looking at some tech companies differently, looking at some growth companies differently. How do you recommend other investors follow your transition? What material should they study? Thank you.
Well, I think, there was a book back in the 60s called The Money Game, written by a guy, the guy's pseudonym was Adam Smith, and was widely read. And at that time, we were dealing with the first wave of the Nifty 50 growth companies, Xerox, IBM, and Texas Instruments, and Hewlett Packard, and so forth. And in this book, which was a work of fiction, in the brokerage office, there was one old guy called the Great Winthrop. He was the oldest guy in the brokerage office, but he was doing the best. So they said to him, how can you, an old guy, be keeping up with the public trends and doing the best? And so he says, come in the back. And they go in the back. He says, these are my kids. This is Huey and Dewey and Louie. And he says, if you want to get ahead in this market, you have to get yourself a young man. So the point is that my son, we lived together for months during the pandemic. His family moved in with us, and we had great head-to-head discussions, especially about growth investing. And he believes that something called value investing has grown up and become, to use one word, theologized, very formalized. And what does it say? It says that, well, the value investor invests rather in mundane companies, usually slow growing. Usually because they're slow growing, a lot of the merit is here in the present. Not too much of the argument depends on what exists in the future. Thus, they're predictable, quantifiable, but because they're not such wonderful companies, vis-a-vis their glowing futures, they don't sell at high PE ratios or high price to book. They're bargains. So that's what value investing, in quotes, has grown into. And Andrew says you can't invest that way anymore, because Buffett used to be 50, 60 years ago. Buffett used to be able to, he says he made a lot of money buying dollars for 50 cents. And you could buy dollars for 50 cents because everybody else was ignorant that there were 50-cent dollars out there. So he would go around the country and pick up these 50-cent dollars. And just imagine, it's hard. I'm sure it's hard for you people to imagine, but imagine no computers. Imagine no online, no internet, no data sources, no feeds, no databases, no screening programs. And everything was done manually. So if you wanted to find, I talk about this I wrote a memo called Something of Value in March, talking about this experience. I'm sorry, January. And, if you wanted to study a company, you want to study General Motors, believe it or not, you had to write to the company and request the annual report. And then a few weeks later, it would come in the mail. And if you wanted to then say, well, I'd like to compare this with Ford, then you would have to write to Ford, and a few weeks later you get their annual. It was very slow and laborious, and a few people had access to these things through the public library, but not too many. And so Buffett would sit in his back room in Omaha with Moody's Manual, which was this book this thick, literally this thick, I would say 8 inches thick, with thousands of pages of the thinnest possible paper. And they had the financials of every public company in America. So if you had nothing to do and a lot of patience, you would sit there and go like this, one page through. And then eventually you say, oh, here's a company that you can buy for less than the cash on the books. And go a little further, say, oh, here's a company selling at 1 times earnings, etc. So, but not many people did it, because not many people knew how to make money in the stock market or knew about the existence of these bargains. So Buffett would find them and take advantage. But now, if you think about it, now the world is an intelligent place. And not intelligent. Let's say people know more. Intelligence is different from knowing stuff. But everybody knows everything. And there's no facts that are not in evidence. And if I'm at dinner and somebody says, "Oh, who hit the most home runs in 1987?" I can tell you like that. Used to take an hour or a day or something. And so what Andrew argued was that the readily available current quantitative information is in everybody's hands. And if it's available to everybody, then clearly, by definition, it can't be the route to superior performance. In order to have superior performance, you have to know something others don't know. You have to either have facts they don't have, and the SEC has the goal of making sure everybody has all the same facts, or you have to have a superior ability to interpret that. But chances are you're not the only smart person who's trying. So it's not even clear you can get an edge that way. So Andrew says you can't base investment success on currently available quantitative information. It has to be, your superiority has to come through either a better understanding of the qualitative information, which by definition, in my opinion, by definition, can't be the result of an algorithm, or superior insight with regard to the future. And that's what the memo is mostly about. And, you know, there's a great quote from Buffett. He says, we are not growth investors or value investors, we're investors. And so the trouble is when things get labeled, then they get narrowly defined. You have to, I think, to be an investor in the coming decades, you have to be broad-minded. And you have to say, I'll buy anything at an attractive price. And, you know, so for the last 30 years, investors, value investors have been saying, we don't buy fast growing companies. We don't buy tech. We don't buy anything with a high PE, but what can you buy today that's not reliant on tech? You know, I mean, 20 years ago or so, you know, Buffett made a ton of money in the Washington Post and other newspapers, and they were moated. They could not be disrupted by technology because every town had a newspaper. You needed a newspaper. It's the only place that the used car lot would advertise. It's the only place you could look to get the movie times. It's the only place that employers could advertise jobs they had available. And the newspaper from the next town wouldn't do because they didn't have the locally relevant information. So each newspaper had a moat and was defensible. And then guess what? The internet came along, and on the internet you can find all the jobs in your town and the next town and the next city and the next country. You don't need a newspaper anymore for that. And the newspapers have been horribly disrupted, and you know, many of them struggling. They got a life preserver when Trump became president because he was so controversial that people were reading the newspapers more. But other than that, it just shows you that there's very little which is immune from technological influence. So so the argument is you have to be broad-minded. You can't say we do this but we don't do that, and you have to be rather than buying mundane companies at low prices, you have to be open to buying good companies at high prices. And, you know, Buffett, there's another quote where Buffett says something like, you know, it's not clear that low PE, low price to sales, low price to book carries the secret of high performance. And it's not clear that high price to book, high PE ratio, high price of sales should be excluded from portfolios. And I think that's what the memo was mostly all about. It was also about trying to overcome our inherent biases and our histories. History is very important because it makes us who we become. And so I'm trying to do that now.
Yeah, that makes a lot of sense. Thank you. Just thinking of another quote from Buffett where he said if he started all over again today and was managing very small amounts of capital, he thinks he would be able to get close to 50% returns per year. And do you think, what are your thoughts on that? Do you think that's still feasible today? What sort of should investors who have very small amounts of capital and are trying to invest in themselves really look for those very small cap international, more obscure stocks?
Well, look, I'm not familiar with the quotation. I don't know when he made it or what he was talking about. It's very hard to have a goal of 50%. 50? Yes, and especially in a low return world, you know. When 25 years ago, no, excuse me, 15 years ago, when the Fed funds rate was, I think, 4, and the 5-year Treasury yielded 6, then, for example, stocks would have to be priced to return 10, 11, 12. in order to compete with fixed income. High yield bonds might have yielded 10 contractual. So stocks had to appear to offer much higher returns. Now, with the Fed funds rate at 0 and treasuries at 1 to 2, people will say, you know, if I could get 6 from stocks, that would be great. So that means in order for the prospective return to come down, the price goes up. And I think that's happened, and that's what's explained the move of the stock market over the last 14 months. Made it very hard to get 15, and so now he says if he had a little money to manage, and of course that's an important key, because you know, the less money you have, the more you can use these tiny situations, which are maybe too small for any other institutions to care about. Anything that discourages people from going into a certain area plays in favor of the people who will go there. And in fact, we talk about the efficient market, things priced fair. In the efficient market, nothing returns 50%, by the way. So nothing in the efficient market, everything's priced fair. But then maybe it's not all perfectly efficient. Maybe there are inefficiencies, what I call mistakes, things that are priced too low, bargains where you can't get very high returns. But if there are bargains, what would be the source of those bargains? What is it that makes those bargains come into existence? And the answer for me is ignorance and apathy. Also bias. So, you know, if everybody knows about it, it's not going to, if something is priced to return 50%, but if everybody finds out about it, it's not going to stay that way. The other thing is, if people say we'll buy high quality stocks at any price, then the return on that on high quality stocks will go to hell, because people will pay too much. If people say I wouldn't touch a B-rated bond at any price, then B-rated bonds can have too high a price, a return relative to their risk. They can be underpriced relative to their risk. That's an inefficiency. But you know, you have to find those things, and size is one of the things that does it. Because you know, I mean, I remember talking to people. You should think about this, that. They say no, too small. They don't say it's not a good company. They don't say it's overpriced. They don't say it doesn't have growth potential. They say too small, despite the merits. Well, then that's where you should look. You got to do the things which are the opposite of the mistakes other people make. But it's not easy. So even if you had a small amount of money to invest, in answer to your question, that's not enough. You still have to have a high level of skill. And you know, just going into so-called inefficient markets or alternative markets, private markets, just going into those markets doesn't give you money, doesn't guarantee you success. You still have to be a superior competitor in order to have success.
Yeah, that makes a lot of sense. Thank you for that commentary. And also, do you have any tips for analysts when they need to analyze stocks, when there may only be a short period, when those investments prices depressed, such as during the flash crash?
Well, the flash crash was only a matter of hours. There's nothing intelligent that can be done in hours. So the only thing that's intelligent is that there are companies that you have been looking at, that you already understand, that you think you would like to buy, that maybe you'd buy them if they went down in price. And then you see the market down, and rather than panic and say it's the end of the world, you just say, well, this is great. It's kind of like Amazon. They just put the world on sale, and you start to buy. But you know, you'd never have the knowledge to say what's going on in the flash crash, or why it's going on, or what's wrong with it. But you just have to have the nerve to buy things when they go on sale. Now, we don't do things in minutes or hours like that, but that's what we did in late 08. we said, well, most people are saying that the world financial system is going to melt down, and we don't think so. There's no way you can prove it's not going to melt down. There's no way you can prove almost anything about the future if you think about it. But I think what I said was, it's hard to put a high probability on the end of the world. And if you think the world's going to end, if we buy, doesn't matter. But if the world doesn't end and we didn't buy, then we didn't do our job. So we got to buy. That was the whole sophisticated analysis. There was no algebra. There was no algorithm. There was no calculus. Very simple. We got to buy, because these are great bargain prices, and if we don't buy, we failed. So you can do that. It's hard to do that in a 1 hour opportunity, but we had a 15-week opportunity, and we were able to put 10 billion to work.
Yeah, that makes a lot of sense. Thank you. And what are some permanent changes that you see in the economy as a result of this pandemic once things recover?
Well, it's hard to know what's going to be permanent, and I think that things are already returning to normal faster than most people thought. I have been a believer that people underestimated the speed at which things would return to normal. I think people have their ways. Usually they have their ways for good reason. Young people like you historically have wanted to live in New York so that they could have a good job, cultural enrichment, and a good social life. And I don't think they're going to change their minds and move to Rye or Providence. I think young people are still going to want to live in New York. So I think they're going to go back in large part to their former behavior. So what I've been saying for the last year is that either 80% of the people are going to go 80% of the way back to their old lifestyle, or 90% of the people will go 90% of the way back to the lifestyle. The world is not going to be fundamentally changed in life as we know it. I think most people are smart enough and now have adjusted, have gotten their emotional equilibrium to the point where they know that that the pandemic, I wouldn't say once in a lifetime, because we may well have another, but I think that it's clearly an exogenous event, a one-off, you might say a black swan, and life in the pandemic is not the new way of life for all of us. It's over. I think it's essentially over now, and it's may not come back for a long time, or it may come back, but now we have a better handle on how to deal with it. But anyway, so I think, look, the one thing we know for sure, the one thing is changed is retail, and retail is moving from in-person to online. But of course, that is a trend that's been underway for half a dozen years at least, and I think that the pandemic merely exacerbated it. And of course, everybody had great success buying online in the last year. But that's not a pandemic-induced change. That was happening anyway. You can't think of many things. Are people going to go to the movies? Maybe not this month, but probably next year. Sporting events, concerts, restaurants. They'll go back to having weddings and bar mitzvahs and christenings and funerals and all that stuff. Some people slower, some people faster, depends on the place, etc. But I think that life is largely going to return to what it always has been.
And do you think there'll be a permanent reduction in corporate travel?
That's an interesting question, and that remains to be seen. On the one hand, we did very well with Zoom, the whole world. The clients may say, look, we don't well, for a little while, they may say, we don't want strangers in the office. And then they may say, look, no, it's a lot for you to go from New York to Des Moines. So let's do a Zoom. Of course, they may forget about that. Now, but what happens when your most important client calls up and says, you say, I'd like to have a meeting. We say, well, we'll Zoom with you. And the client says, I'm not important enough to you to come see me like you always used to. And it's going to be very hard to say, no, we're not traveling anymore. Clients call the tunes. And so the answer is, I think business travel will come back a little slower than some other things, but it'll come back, and it may not come back to the same level as it would have been ex the pandemic, but I think it'll come back.
Yeah, that makes a lot of sense. Thank you. And then as a concluding question, what qualities, background, and experiences are you looking for in college students who dream of one day interning at Oaktree?
Well, look, we obviously want people who are highly intelligent, numerate, very good reasoners, and people who are nonconformists. And I in my books I talk about something called second level thinking, and we want people who are able to think differently from others and better. So those are kind of the necessary conditions. But I think that in addition, Oaktree, which prides itself on its culture and is dedicated to preserving the culture, and that's a big part of my job, and it's one of the things that's most important to me. Oaktree wants team players, nice people you want to associate with. Life is really too short to work with jerks, and there are a lot of jerks around there, and there are a lot of jerks who can make you a lot of money. But we try to have the discipline to not hire or retain them. And it can be hard because, you could say, well, if we let this person go, we'll make $10 million less next year. But it's the right thing. And, when we've done it in the past, we had very good results, because not only do we get a noxious presence out of the company, but the other employees say, that's great that you did that. Because, if you say, well, our goal is to have a harmonious office environment and no office politics and no jerks, but you keep the jerks because they make you a lot of money, then people say, oh, I guess the culture thing is an empty thing. And it's really very important to us. And so it's very important to show to the employees that you're willing to walk the walk. Teamwork is very important to us. In some places, especially in the hedge fund culture, if that's the right way to call it, they say you eat what you kill. Every person has the personal balance sheet, and you get a percentage of what you make that year. And not only do you do better if you get paid more if you do better, but you probably get paid more if somebody else does worse. So it's an anti-teamwork thing, and we want people who want to work together. And the other thing is that we don't just pay people for their quantitative accomplishments last year. We also pay them for their qualitative accomplishments and for their teamwork and for what we believe is their potential. And one of my favorite quotes is from Einstein, who said, not everything that counts can be counted, and not everything that can be counted counts. And just because something can be quantified and machinized doesn't mean that it's the stuff that's important. So, we have a great group of people that I enjoy associating with. And even if I don't think it costs us any money, but even if it did, it would be worth it.
Yeah, absolutely. Thank you so much, Mr. Marks. And
Okay.
Thank you for taking the time out of your busy schedule to join us today.
Not too busy for you. And thanks for all your good questions. My daughter went to Brown, by the way, and she came out well anyway.
Yeah. Thank you. Have a great day.
Okay. Take care. Bye-bye.
Thanks.